ladies and gentlemen, today we will present finance. This is all our group members, Dae Hyun, Daniel, and seolmi. So now I'll explain about the company. The name of the company is Tirtodjojo Group. It is a leading property developer on Malaysia. The group started out in 1974 as a construction company, and then listed on the Bursa Malaysia in 1993. And in 1996, it refocused its core business to the property development. And the company have 3 branches that are located in the 3 key economic centers in Malaysia. They are in Klang Valley, and then in Johor Bahru and Penang. And the company serving in different countries, such as like Vietnam, Australia, and Singapore, and China. And in September 2012, the company widened its partnership to 2 other countries, such as China and United Kingdom.
And I will explain about the liquidity ratio. The current ratio matches current assets with current liabilities, tells us whether the current assets are enough to settle current liabilities. Current ratio below 1 shows liquidity problem. The total current liabilities exceed total current assets. So in this case, the company's current ratio decreased from 4.18 times to 1.01 times in 2011 and 2012. Respectively, which indicates that it does not have sufficient current assets to meet its short-term obligations. The significant activities. These are the increase in current liabilities. There is a huge difference between short-term borrowing of 2012 and 2011. And there was no redeemable serial bonds and bank overdraft in 2011, but in 2012. Quick ratio. Quick ratio measures the liquidity of a business by comparing its cash and near cash current assets with its short-term liabilities. Basically, a higher quick ratio is preferable. That means greater liquidity, which shows that the company managed to repay all its debt by using its cash in marketable securities and accounts receivable. The quick ratio of the company shows a big decrease from 4.18 times in 2011 to 1.01 times in 2012.
This average collection period, which is also known as debtor's day, is to measure the efficiency of the company is controlling its debtor and the average time a credit customer to pay for the debts. And then increase in average collection period for the company from 45 days in 2011 to 792 days in 2012 indicates poor credit control with longer credit terms being offered to customer to improve sales. And this mainly due to the revenue in 2012 has dropped dramatically compared to previous year. Besides, the account receivable has increased as well. And the last, as a result, some potential liquidity problems such as the debts will not be paid by customer, leading to bad debt problem may occur. So, action to improve debt collection procedure is required to reduce the risk of bad debt. And total asset turnover ratio mainly is to assess how well the assets of the company have been used efficiently to generate sales. If a company can generate more sales with fewer assets, it has a higher turnover ratio, which tells it's a good company because it's using its asset efficiently. The company asset turnover ratio has decreased drastically from 0.01 times to 0.0007 times in 2011 and 2012 respectively. And for the last, this indicates that the company used its asset of the business more effectively in 2011 than 2012. The significant activity. The significant decrease in the asset turnover for the company might be due to the following reasons: drop of sales value, increase in non-current asset, increase in total amount of current asset. Debt ratio. For the debt ratio ranges from 0.00 to 1.00. Lower value of debt ratio is preferable, and higher value indicates that higher portion of the company's assets are financed by its creditors, which means higher risk is in operation because company would find it difficult to obtain loans for new projects. Debt ratio of 0.5 indicates that half of the company assets are financial through debts. And the last is the company debt ratio is higher in the year 2012, which is 0.304 times compared to previous year 2011 of 0.182 times. This shows that the company used more assets to finance the liability of the company. Gross profit margin. Gross profit margin measures profitability. Higher value of the margin are considered preferable because more profit will be available to cover non-production costs. Based on the redraft statement of profit or loss above, the gross profit margin of the company shows that the company is experiencing more than half of increase in the GDP margin, which is from 0.318 times in 2012 to 1 times in 2012. Operating profit margin. A higher value of operating margin ratio is preferable, which indicates that more proportion of revenue is converted to operating income. And increasing in operating margin ratio over time means that the profitability is improving. In general, a business which is more efficient is controlling its overall cost will have higher operating margin ratio. The company is experiencing a huge increase in operating profit margin from year 2011 to 2012. From the table above, it shows that the operating profit margin rises from 1.052 times to 89.403 times. It might because of the extreme sales drop in 2012, even though there was not much difference of operating profit between these 2 years. Net profit margin. A company after tax profit margin is essential because it tells investor the percentage of money a company actually earns per dollar of sales. This ratio is interpreted in the same way as profit margin, but the net profit margin is simply more stringent because it takes tax into account. The company net profit margin has increased from 0.48 times to 74.35 times in 2011 and 2012 respectively. Net earning per share. Earning per share or EPS of a business is the portion of its net income of period that can be attributed to its share of its common stock. EPS also serves as an indicator of company profitability, and trends in EPS help to assess the investment potential of the company share. The increase of EPS of the company from 0.9 cents per share in 2011 to 10.2 cents per share in 2011 indicates that the company is more efficient at using its capital to generate income compared to previous year. As a result, the company is able to attract new investors if the situation continues in the next accounting period. In addition, the existing shareholder will feel satisfied for this result as the potential earning looks promising to them. And then return of total asset. Return of total asset or ROE indicates the number of cents earned on each dollar of assets. Thus, higher value of the return on asset show that business is more profitable. In 2012, the company ROE has increased from 0.6 cents in 2011 to 4.9 cents, which show that the company is experiencing a great improvement in profitability. The significant activities, the improvement in ROE is mainly due to the factor as stated below.
The market ratio. The market ratio compared to 2011, the price is cheaper in year 2012 in relative to the earning of SP G4 Hub. The market ratio shows a higher ratio in 2011 than year 2012. The higher the ratio means people expect the management can perform well in the future.
As conclusion, we have chosen to invest the 1 million ringgit in SP Setia Berhad after consideration due to the following factor. The first factor is the company is experiencing a growth. We can conclude this from the aspect of increasing trend in profit margin. The second one is the increasing earning per share. Looks like there will be more potential earning in the future. It is performing quite well because it still holds more current assets than current liabilities. Even the current ratio and quick ratio decrease. The fourth point is the unfavorable average collection period of the company need to be improved by improving the efficiency in collecting the trade receivable and improving sales. In terms of efficiency of utilizing the resources of company, the company had done a good work on utilizing the resources. In sum, the company has a potential growth and it will generate more income in the future. Hence, investing the 1 million ringgit in this company is definitely a wise decision. That's all. Thank you.